1 minute remaining. I'll lead with the US interest rate decision. Seconds. Cut 25 basis points, cut 25 basis points, cut to 4.25% as expected. Current year rate forecast at 3.625%, 3.625%, lower than the expected 3.875%. Next year's rate forecast at 3.375% as expected. Over the next 2 years, 3.125% as expected. And over the next 3 years, 3.125% as expected. Long run at 3% as expected. So the Fed say downside risks to employment have risen. Median projections show 50 basis points more cuts in 2025. So again, Fed median projections showing 50 basis points more cuts this year. Cuts the target rate again to 4.25%. And says Governor Moran dissented in favour of a half-point cut. So Fed officials' median view of the Fed funds rate at the end of 2027 at 3.1%. Median view of the Fed funds rate end of 2028 at 3.1%. Longer run seen at 3%. Again, the projections implying 50 basis points of cuts this year, 25 basis points of cuts in 2026, and 25 basis points of cuts in 2027. The projections show that 9 of the 19 officials see 2 additional cuts this year, 2 see 1 cut, and 6 see no more reductions. Policymakers see a 4.5% unemployment rate at the end of this year, unchanged from the prior forecast. Again, the projections show one policymaker estimated the appropriate policy rate by the end of the year was 4.5%, unchanged, and one saw it at 3%. Policymakers see the end of this year's PCE inflation at 3%, unchanged from the June projections, core seen at 3.1%, unchanged as well. So looking to the market, strength in the S&P 500, weakness in the dollar coming through here, following the release of this latest SEP. So Fed policymakers in the SEP see 1.6% GDP growth this year versus 1.4% in June, and they see the longer run growth at 1.8% unchanged from the June projections. Traders add to bets on at least one more Fed rate cut this year. So again, the Fed projections there are the main point of contention from the SEP here. So they're seeing a further 50 basis points of cuts this year in the dot plot. We've posted the link to the full SEP on the site as well for those interested. Again, this led to weakness in the dollar, government bond yields as well, strength coming through in the US indices, and US rate futures now pricing in a total of 69 basis points of cuts this year following the Fed statement, which really is little changed from before.
Voice news disconnected.
So the Russell 2000 rising 2%, on track for its first record since 2021. US 10-year yield falls back below 4%, near last week's low. US rate futures pricing in a 94% chance of a cut in October following the Fed statement. It was at 71.6% before. Rate futures pricing in 69 basis points of cuts this year following the Fed statement. Little changed in total. Spot gold hitting a record high. So after the rate decision now, we're seeing gains in the US stocks reversing now. S&P 500 down spot 2%, Nasdaq down spot 7%. The Dow is up though, spot 8%.
If you're a real day trader, go real time at financialjuice.com/purchase and save 67% on a subscription. Isn't that one big, huge, brilliant deal? Come on, people.
US 10-year yield falls below 3.99%, lowest since April.
So in 10 minutes time now, at the bottom of the hour, we get the FOMC press conference with Chairman Powell. We have posted the live video to this on the feed for those interested.
S&P 500 rebounds back in positive territory.
And Powell beginning the presser.
Of maximum employment and stable prices for
Fed's
the
Powell
benefit
says
of the American
unemployment
people.
remains low but has edged up.
While the unemployment rate
Inflation
remains low,
has risen
it has
recently
edged
and
up.
remains
Job
somewhat
gains
elevated.
have slowed and downside
Job
risks to
gains have slowed,
employment have risen.
downside employment risks risen.
At the same time, inflation has risen recently and remains
Voice
somewhat
news
elevated.
disconnected.
In support of our goals and in light of the shift in the balance of risks, today the Federal Open Market Committee decided to lower our policy interest rate by a 0.25 percentage point. We also decided to continue to reduce our securities holdings. I'll have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a pace of around 1.5% in the first half of the year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles has picked up from last year's pace. Activity in the housing sector remains weak. In our summary of economic projections, the median participant projects GDP to rise 1.6% this year and 1.8% next year, a touch stronger than projected in June. In the labor market, the unemployment rate edged up to 4.3% in August, but remains little changed over the past year at a relatively low level. Payroll job gains have slowed significantly to a pace of just 29,000 per month over the past 3 months. A good part of this slowing likely reflects a decline in the growth of the labor force due to lower immigration and lower labor force participation. Even so, labor demand has softened, and the recent pace of job creation appears to be running below the break-even rate needed to hold the unemployment rate constant. In addition, wage growth has continued to moderate while still outpacing inflation. Overall, the market slowing in both the supply of and demand for workers is unusual. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen. In our SEP, the median projection for the unemployment rate is 4.5% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. over the 12 months ending in August, and that, excluding the volatile food and energy categories, core PCE prices rose 2.9%. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up, on balance, over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 3.0% this year and falls to 2.6% in 2026 and to 2.1% in 2027. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a quarter percentage point to 4 to 4.25%, and to continue reducing the size of our balance sheet. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to push up prices in some categories of goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside, a challenging situation. When our goals are in tension like this, our framework calls for us to balance both sides of our dual mandate. With downside risks to employment having increased, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate, based on what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.6% at the end of this year, 3.4% at the end of 2026, and 3.1% at the end of 2027. This path is 1/4 percentage point lower than projected in June. As is always the case, these individual forecasts are subject to uncertainty, and they're not a committee plan or decision. Policy is not on a preset course. The Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission, and we at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to our discussion.
Great. Thank you. Chris Rugaber at Associated Press. As you know, Fed Governor Stephen Miron has kept his position at the White House, even as he's joined the Fed board. This is the first time, I believe, the Fed's board has had someone with executive branch ties in decades. Does this compromise the Fed's independence from day-to-day politics? And relatedly, how can you maintain the public's perception the Fed is politically independent with this dynamic? Thank you.
So we did welcome a new committee member today, as we always do, and the committee remains united in pursuing our dual mandate goals. We're strongly committed to maintaining our independence, and beyond that, I really don't have anything to share.
You and other Fed officials have spoken extensively about the impact of tariffs on inflation. although perhaps with many companies appearing to eat the tariffs, tariffs may be impacting the labor market and other parts of the economy instead. Do you see that as a possible outcome here, that tariffs are the reason we're seeing some slowing, particularly in the labor market, rather than in inflation?
You know, it's certainly possible. You know, we're beginning to see, we have begun to see goods prices showing through into higher inflation, and actually the increase in goods prices accounts for most of the increase in inflation, or perhaps all of the increase in inflation over the course of this year. Those are not very large effects at this point. And we do expect them to continue to build over the course of the rest of the year and into next year. And you know, it's also possible that there may be effects on employment, but that I would say if you're looking at why employment is doing what it's doing, that's much more about the change in immigration. So the supply of workers has obviously come way down. There's very little growth, if any, in the supply of workers, and at the same time, demand for workers has also come down quite sharply. And to the point where we see what I've called a curious balance. You know, typically when we say things are in balance, that sounds good, but in this case, the balance is because both supply and demand have come down quite sharply. Now demand coming down a little more sharply because we now see the unemployment rate edging up.
Chair Powell, do economic conditions and the balance of risks no longer warrant a restrictive policy setting?
So I don't think we can say that. What we can say is this, that over the course of this year, we've kept our policy at a restrictive level, and people have different views, but a clearly restrictive level, I would say. So, and we were able to do that over the course of this year because the labor market was in very solid condition with strong job creation and all those things. I think if you go back to April and now look at the revised job creation numbers for May, June, July, and August, I can no longer say that. So what that means is that the risks were clearly tilted toward inflation. I would say they're moving toward equality. Maybe they're not quite out of equality. We don't need to know that, but we do know that they've moved meaningfully toward greater equality, the risks between the two goals, and that suggests that we should be moving in the direction of neutral, and that's what we did today.
Under what circumstances would a larger than 25 basis points rate cut be warranted, and how seriously was that option entertained at your meeting this week?
There wasn't widespread support at all for a 50 basis point cut today. You know, I think we've done very large rate hikes and very large rate cuts in the last 5 years. And you tend to do those at a time when you feel that policy is out of place and needs to move quickly to a new place. That's not at all what I feel certainly now. I feel like our policy has been doing the right thing so far this year. I think we were right to wait and see how tariffs and inflation and the labor market evolved. I think we're now reacting to the much lower level of job creation and other evidence of softening in the labor market and saying, well, those risks are maybe not fully balanced, but moving in the direction of balance now, and so that warrants a change in policy.
Colby Smith for the New York Times. Should we be viewing today's cut as the committee taking out some insurance against the possibility that the labor market is at risk of weakening, or is it the committee's view that the dynamics of a downturn are already in place? I guess I'm just, trying to square the shift in the rate forecast in the SEP towards more cuts than just 3 months ago, with the fact that the forecast for unemployment didn't change.
Yeah, I think you could think of this in a way as a risk management cut, because if you look at the SEP, actually the projections for growth this year and next actually ticked up just a little bit, and inflation and unemployment didn't really move much. So what's different now? What's different now is that you see a very different picture of the risks to the labor market. You've seen, we were looking at 150,000 jobs a month at the time of the last meeting. And now we see the revisions and we see the new numbers. And I don't want to put too much emphasis on payroll job creation, but it's just one of the things that suggests that the labor market is really cooling off. And that tells you that it's time to take that into account in our policy.
Super helpful.
See if you can save money.
The SEP, once again, the median participant has inflation higher than previously expected by the end of next year, and the Fed not getting back to the 2% target until 2028. So I guess I'm just wondering how you characterize the risk to price pressures of kicking off
I'm a big fan of
series of
solo
cuts
traveling.
at this point.
I think traveling solo
Yeah,
is
so
one of the best ways
I would look
to
at it this
really
way.
get to know who we are.
We fully
But when
understand and
I was
appreciate
staying at one
that we
family's
need to
place, when I
remain
was
fully committed to
sleeping,
restoring
one incident happened, and a
2%
lot of things
inflation
came into my
on a
mind.
sustained basis, and we will do that. At
I
the
was
same
afraid
time,
that
we've
if
got
I
to weigh
tell
the
this
risks
to
to the
my
two
parents,
goals.
they will say,
And
"Who
I would
told
say
you? Why did you travel
really since
solo?"
April, to me, the risks of higher and more persistent
Later, I
inflation
found
have
out
probably
that in the
become
world, over
a little
90%
less.
of
And
women
that's partly
wish
because
to
the
go
labor
solo
market has
traveling,
softened,
but hesitate
GDP
out
growth
of
has
safety
slowed,
and security
um,
reasons.
and
That's why
so I would
created
just say
another.
that the
My
risks
very
there have
big
been
idea
less
was to create something
than
to
one
support
might think.
women to travel
And in terms of
safely.
the labor market, what we're seeing is unemployment is
first
still
thing I did
low,
was
it's still
talk
at relatively
to
low
some
rate, but we're
female
seeing downside risks.
And a lot of them told me I will feel more comfortable if I get a chance to meet other local women.
Michael McKee
or
from
other
Bloomberg
female
Radio
travelers.
and television.
First, they want to know
I'm
deeper about the, like,
a little
ladies and
confused
so I
by
was thinking,
your
what
explanation of
if
the
I
Fed
create a
cutting rates because of
mobile
unemployment.
application
If you
where I
think
can
that most of
connect
what's
all
happening in
these
the
women
employment
around
area
the
is
world.
related to immigration, which
Through
your
Zoom app,
rate
you can
cuts wouldn't
basically meet
address,
other female travelers, share tips
how do
and
you see
information.
that
They can
as more
participate
important
in
than
organized
inflation,
travel
which has
camps
remained
as we have partnership
almost a
with
full percentage
local
point above your target?
women-owned businesses.
Well, I was saying that
Google
what's
Play
happening in the
has
labor market
helped
has
us
more to do
enormously.
with immigration than it has to do with
I can
tariffs. That was
reach
the
every
question I
single
was
place
answering.
in the world,
So
literally
I wouldn't say that
190
all of
different
what's happening in
countries.
the labor market
I can
is due to
see
tariffs.
user
I mean,
coming
you
from
clearly have a
Rwanda, user
slowing
coming
in
from Kenya,
due to
Suriname,
immigration. You
Peru.
clearly have a slowing in demand,
They are
which is
sharing
now
amazing
perhaps
women
more than that
support
in
each other
supply,
to dream
and we
bigger,
know that because the
to go on
unemployment rate has
adventure and
ticked up.
travel solo.
So
That's the power of
So
community.
that's
Once
that's
people
what I meant by
know
that.
there are
Like a
other
follow-up,
people who are
every
trusting
year
and
since
believing in,
2015, the
it's so
SEP
easy
has
to
forecast
have
that you would
and
hit your
gain this
target
momentum.
2 years later.
We are
And
not
this year,
just creating an
this
offer
SEP
to travel.
says you're going to hit your target 2 years later.
We are creating a
2%
movement
does
for
not
women
seem to be in
speak
sight.
our
Does
voice
that
and send our
suggest that
message
the 2%
that you travel
target
solo,
is
but
not
you're
really
together
achievable?
and you can dream
And does
bigger.
this present any credibility problems for you in telling people that that's what you're going to do if you can never reach it?
Well, I mean, you're right. It does say we're going to get to 2% inflation in 2028 at the end of 28. But that's literally how you put the projections together. You're writing down a rate path, which is designed to create over the course of the SEP, time frame, 2% inflation and maximum employment too. So that's all that is. No one really knows where the economy will be in 3 years. But the nature of the exercise is to write down policy that you believe would return to the 2% goal over at least by the end of the exercise.
Thanks so much, Elizabeth Schulze with ABC News. The latest inflation report shows that prices are still going up across key categories for many households, including groceries. What will the Fed do if prices pick up more?
So our expectation, and you can see this consistently through the year, has been that inflation will move up this year, but that basically because of the effects on goods prices from tariffs, but that those will turn out to be a one-time price increase as opposed to creating an inflationary process. That's been our forecast. Pretty much all the individual forecasts say that. We can't just assume that, though.